Good morning, ladies and gentlemen. Goeiemôre, dames en here. Welcome to this very exciting and important webinar called How to Value a Trust, with particular reference to a business trust, including SARS valuation rules for trusts. For your information, our final webinar to be presented after this valuation is How to Value an ICT company, in particular software company and software products, including the software intellectual property, enterprise and equity valuation of a software company. For your information and edification, we supply you with a comprehensive list of previous webinars that you might like to invest in terms of MP4 videos and electronic soft copy notes. As usual, at the end of the presentation, we'll do an electronic lucky draw, and the prizes on offer are 2 publications written by Dr. Advocate Lee Yeffer, question and answers for accounting officers and members of CCs in relation to the Companies Act and the amended Close Corporation Act, and Vra en Antwoorde oor die Suid-Afrikaanse Maatskappy-wet. How to value a trust, including SARS valuation rules for trusts. The webinar program consists of 9 sessions. After the introduction, Session 1, Impact of Types of Trusts and Valuation Considerations. Session 2, Comparison of Types of Trust Entities on Valuation Approaches. Session 3, Business Trust and Valuations. Session 4, SARS Valuation Rules and Trusts. Session 5, Trust Valuation Equation. Session 6, Trust Valuation Process, Step by Step. Session 7, Trust Value Platform, Value Drivers and Assumptions. Session 8, Trust Valuation Methodology. And then we do a Business Trust Valuation Case Study, followed by How to Value a Trust Literacy Test, and we conclude with a question and answer session. Introduction. Can a trust be valued? Yes, anything, an asset or an entity, can be valued if it meets 3 fundamental conditions. Condition 1, it owns a right. Condition 2, it owns tangible or intangible resources or assets. Condition 3, that right and or assets meets 1 or more valuation approach requirements. Approach number 1, does it have an embedded cost or cost of replacement? Or is there a transaction price that will result between a willing buyer and a willing seller, the transaction being done on an arm's length basis? Thirdly, can a fundamental valuation be done based on future generated revenue or earning streams, whether it's positive or negative earnings? So the question is in relation to the type of trust, which of the 3 valuation considerations are applicable that will influence and determine the valuation calculation, measurement and computation. The focus today is on the valuation of business trusts. In a valuation of a business trust, there are 6 key considerations. Firstly, the type of trust, for example, inter vivos or testamentary trust, discretionary or non-discretionary, pre-tax or post-tax position, the risk rating, trust deed, tax rates, assets at market value. And in relation to the market value, we come to our first rule from SARS perspective. It's in Section 80, Bracket 7 of the Income Tax Act. SARS defines market value as, in relation to an asset, market value means the price that could be obtained between a willing buyer and a willing seller of the assets, e.g. the shares, dealing freely at arm's length in an open market, e.g. as if the shares were unrestricted. There are 2 types of trust from a formation perspective: the inter vivos trust and testamentary trust. Inter vivos trust is formed during the lifetime of the donor or the founder of the trust. There's the trust deed instrument. There's a flexibility in terms of amendments, and assets are transferred into a trust. In other words, the trust capitalization is during the lifetime of the founder. On the other hand, testamentary trust is formed after death, done by the executors. The instrument is the will. It's less flexible, and the assets are transferred after death in terms of the will. In all cases, trust needs trustees, and trustees hold the assets irrespective whether it's an inter vivos trust or testamentary trust in a fiduciary capacity for the benefit of beneficiaries. This is the superordinate goal, the superordinate objective, priority number one for trustees: to hold assets in a fiduciary capacity, trust assets for the benefit of beneficiaries. What are the principal roles of trust? Principal benefits is number one, value protection. Secondly, value creation and value growth. The challenges and implications in valuing a trust relates to four elements. First of all, the understanding of the type of trust, whether, for example, it's discretionary or a vested trust. Secondly, ownership of the trust assets. For example, who is the bona fide legal owner of trust assets? Is it the trust per se or the trustee? Thirdly, the trust in relation to taxes and trust valuations. And fourthly, the issue around if it's a business trust or a non-business trust, and in particular, the business trust valuation process around the enterprise business operations valuation and the equity or capital of the trust or net asset value of the trust valuation. Question is very important: when does a person control a trust? A person controls a trust if four conditions are met. One, has the ability to control the majority of the votes of the trustees. For example, an independent trustee is appointed with that objective. Secondly, has the ability to appoint the majority of trustees. Thirdly, has the ability to appoint or change the majority of the beneficiaries of the trust. And fourthly, has the ability to materially influence the policy and procedure and processes of the trust in a manner comparable to that of a person who in ordinary commercial practice would be able to exercise an element of control. For example, the directors of a company. Session 1. Impact of trusts and valuation considerations. What is a trust? A trust is a legal entity administered by the Trust Property Control Act, where assets of individuals or corporates, e.g. companies and close corporations, are donated to the trust for the benefit of designated and nominated beneficiaries under the management and control of a trustee who effectively fulfills the role of the CEO of a company. So if one looks at the comparison between trusts and companies, beneficiaries effectively are the shareholders of a company. In other words, the shareholders of a company can be compared with the beneficiaries of a trust, and the directors of a company can be compared with the trustees of a trust, effectively achieving the same goals and objectives and roles and responsibilities. In other words, the trustee must operate in the best interest of the trust, as directors should be operating in the best interest of the company. And if you operate in the best interest of the trust, you will be operating in the best interest of the beneficiaries. There are numerous types and categories of trusts, but per se, in relation to individuals, the donors, the founders, can donate their assets to the trust during their lifetime, usually called an inter vivos trust. or the trust comes into existence on the death of an individual, which in terms of the will donates certain assets out of the deceased estate to a trust to be formed or has been formed prior to death, usually known as a trust mortis causa or a testamentary trust. In many corporates, trusts are created for specific purposes, such as corporate social responsibility and corporate social investment purposes, like a charitable trust or a educational trust or an empowerment trust. In many organizations and corporates, their pension funds of employees, medical aid schemes have specific trusts. For example, pension contributions of employees and employers is normally controlled, administered, managed, invested by special funds administrator in terms of the Pensions Fund Act, with a dedicated pension fund trust managed by a board of trustees. So, what is the purpose of a trust? As previously mentioned, to ensure that the assets of the trust for the benefit of the beneficiary are protected by it being administered in a legal entity separate from its source, namely company or individual, and these cannot be subject to disposal or liquidation in the event that the beneficiary becomes insolvent or forms part of a liquidation order. And in the New Companies Act, they define in the definitions to the New Companies Act, a juristic person includes a trust. So the Companies Act recognizes that a trust is a separate legal entity, a juristic entity. Secondly, purpose of a trust: to provide protection from third parties and ensure that the funds are not used to fund financial losses and liabilities if the fiduciary assets were kept in an individual's bank account or the company closed corporation's bank account. And thirdly, that the trust fund's management performance is controlled, is protected, and can be clearly managed and measured apart from the entity's core business that is vested in a company or closed corporation, and that the trustees are fulfilling their particular fiduciary role and effectively managing the trust assets and trust funds. The superordinate objective of a trustee's job description, key result areas, key performance indicators can be described around 5 fundamental roles. The governance role, which is govern and direct. The stewardship of assets role, which is control and manage the assets. The control role, in terms of the overall supervision of the trust operations. The fiduciary role, to make sure that the assets are managed and are utilized and are invested to protect, based on the fiduciary role, that it's assets on behalf of a third party, namely beneficiaries, and the administrative and compliance and legal role. Key concepts and definitions. To paint a picture, to have an understanding of where we're going in terms of valuations, we need to understand the fundamentals, the basics, the key concepts. Beneficiary, the individual or group of individuals for whom a trust is created and who may benefit under the trust. Empowerment trust, a trust created to give every employee a stake or share within a business and to share in the profits of a business via dividend payouts. Very important, discretionary trust, a trust which in terms of the trust deed allows the trustee the right to acquire assets and conduct speculative ventures, pay taxes, and distribute profits to the beneficiaries. Charitable trust, a trust that has been created for the advancement of education, promotion of public benefits, or any other public affairs as contemplated in law. Family trust, a type of discretionary trust set up for the benefit of members of a family. Founder is the trust creator, settler, or donor that designates the beneficiaries and trustees and makes the initial contribution or donation. A business trust also known as a trading trust, that carries on a business where the trustees are effectively the directors and the beneficiaries are effectively the shareholders. And the independent trustee is a trustee that is not related to the founders nor to the beneficiaries. Inter vivos trust, a trust created by a person who is still alive. Testamentary trust is a trust created in terms of the will of a deceased estate, also known as a trust mortis causa. Offshore trust is a trust that is formed under the laws of an offshore jurisdiction. Public benefit organization, an organization that operates in the best interest of the public and can be incorporated as a company, otherwise known as a NPC, non-profit company, or a charitable trust. Letters of authority is the document issued by the Master of the High Court regarding the appointment of a competent person or persons to handle certain matters such as trust, trustee, and in particular deceased estates, in terms of the executor's letters of authority, trustees' letters of authority. Trustees are the persons having the legal responsibility to control, manage, and administer the assets of the trust. Trust deed. This is the legal document that states the founder's, settlers' wishes and sets up the trust. A trust is a juristic person, a legal entity, as defined in terms of the New Companies Act, Section 1, a legal arrangement whereby one person, the donor, founder, grantor, settler, entrusts assets to another person, trustee, to manage those assets for the benefit of others, the beneficiaries. Finally, trust instrument is a written will creating a testamentary trust, or a trust deed creating an inter vivos trust. And in most cases where there is a testamentary trust, a trust deed is still created after the will document. The structure of a trust. The schematic presentation relates to 5 fundamental players and entities. The founder is the person who forms a trust in order to transfer ownership of assets and funds into the trust. The trust entity holds the trust property. Trustees are appointed, those who administer and control the trust assets for the benefit of the beneficiaries. The assets of the trust are trust property that is transferred to the trust by way of donation, sale, or on death. And the beneficiaries, those who benefit from the assets from the trust funds, can either be in terms of income or capital beneficiaries and can have either vested or discretionary rights. What are the essential requirements for a valid trust? Trust deed and a valid trust must, the founder must have a serious intention to create a trust and transfer control. The trust must set up in writing in the trust instrument, otherwise known as the trust deed. The trust property must be clearly identified. Trust objectives and goals must be clearly stated and lawful. There must be a binding obligation on the trustees to administer the trust property. Trustees must be authorized and have capacity. There must be at least one beneficiary. Trust beneficiaries must be clearly identified. What is a special trust? For information purposes, the income tax defines 2 types of special trusts as follows: special trust for incapacitated persons and special trust in relation to a testamentary trust. In relation to incapacitated persons, this is a trust created for the maintenance and care of a person with a mental illness or any serious physical disability which precludes him or her from earning sufficient income or managing his or her own affairs. In the event that this person dies prior to or on the last day of the year of assessment, which is normally the end of February, the trust will no longer be regarded as a special trust. In relation to trusts, special trusts created in terms of a testamentary trust, this is a trust created by a testator by or in terms of his or her will solely for the maintenance and care of his relatives were on the date of death of the deceased, including any beneficiary who has been conceived but not yet born on that date, where the youngest of those beneficiaries is on the last day of the year of assessment of their trust under the age of 21 years. In the event that the youngest beneficiary turns 21 years of age prior to or on the last day of the year assessment, the trust will no longer be regarded as a special trust. In these cases, these two types of special trusts are taxed at the same rate as individuals at their maximum marginal rates, and there is no primary rebate or interest exemption. And in relation to tax year ended 2018-2019, the special trusts in relation to taxable income is taxed at 45% or 45 cents in the rand. Question: may a trust be a beneficiary trust? Yes. Instead of the trustees of a trust making a distribution to a beneficiary, the distribution may, at the discretion of the trustees, be made to another trust of which he or she is the beneficiary. In the event that trustees may create further trusts, the appointment of beneficiaries must not be unfettered, which in the case of a testamentary trust would amount to a delegation of testamentary power, and in the case of an inter vivos trust would amount to a vagueness. Session 2. The comparison of types of trust entities and valuation approaches and valuation methods. Coming to this important distinction between discretionary trust versus non-discretionary trusts. There are two basic types of trusts, discretionary and non-discretionary. Depending on the individual circumstances, understanding of the key differences between these two types of trust can be significant and is significant. Discretionary trust is where the beneficiaries of the discretionary trust generally have no control over any of the assets within the discretionary trust and or how the assets are distributed. The appointed trustees manage the trust funds and assets for the beneficiaries' benefit and have full decision-making authority on whether to advance funds to one or more beneficiaries or to spend the funds on their behalf. In other words, discretion is being given to trustees. The trustees have the discretion. In a non-discretionary trust, the trustees do not have the discretion. For example, under non-discretionary trust, the trustees does not have full authority over how the trust assets are distributed or paid out. In some cases, one or more of the beneficiaries may have partial control over the distribution of the assets held in trust, and in other cases, the trustees is simply required to distribute trust assets and income according to predetermined instructions. In relation to discretionary trusts versus non-discretionary trusts, I've developed a strategic decision matrix that asks 4 questions. And depending on the answers to these 4 questions will determine whether the trust is a discretionary trust or whether it's a non-discretionary trust. Question: does the trustee have full control over the trust assets? Yes or no? Question: does the trustee have full decision-making authority on whether to advance funds? Yes or no? Question: does the trustee have full decision-making authority on whether to spend funds on behalf of the beneficiaries? Yes or no? Question: does the trustee have full decision-making authority on which beneficiary should receive a distribution of funds and or profits? Yes or no? If for all of the above questions the answer is yes, then the trust is a discretionary trust. If for any of the above the answer is no, then the trust is a non-discretionary trust. What is the caveat? Caveat emptor, caveat vendetta, caveat professional, caveat buyer, caveat seller, caveat accountant, auditor, attorney, professional, consultant. The trust deed needs to confirm the type of trust in writing. That is, whether the trust is a discretionary trust or non-discretionary trust. in relation to the above control and authority powers vested in the trustee. Absolutely essential requirement to be embedded in the trust deed. This sets the tone at the top in relation to strategic activities, authority around the trustee. Valuing a non-discretionary trust, that is a non-business trust, needs to be clarified. And the rules of the game are as follows. To value non-discretionary trust assets, we use the fair market value approach, which is the market value based on what an unpressured buyer in the market would pay. Willing buyer, willing seller. However, in their nature, trust interests cannot be sold. In other words, we do not have a notional buyer, a notional seller, or a surrogate buyer or surrogate seller. There's no benchmark. And in this case, the courts have relied on the value to owner approach as a fair valuation of the value. In other words, it looks at the embedded costs, the cost or the replacement costs, less depreciation, which is other known as the depreciated replacement method, and looks at that as the preferred valuation method. The value to owner approach is therefore the price that the owner of an asset, in this case the beneficiary, would hypothetically pay to not be deprived of it. In other words, the minimum price that would be asked for or sold in relation to the beneficiary's requirements. There are slightly different rules that will apply if the trust is made up of capital interest or income interest. The valuation of a non-discretionary trust that is not a business trust. From a valuation of a discretionary trust, these are the rules of the game. Discretionary trusts are more complex to value. There's currently no definitive method to value a discretionary trust in relation to non-business operations, but three methods have generally been recognized by the courts, namely, Method 1, by evaluating the likelihood of the beneficiary receiving benefits by examining the purpose of the trust or the history of past receipts. Secondly, using a notional surrogate pro rata approach that divides the interest by the number of beneficiaries at the date of valuation. That is, if there are 2 beneficiaries, for example, each are assumed to have a 50% interest in the trust. If there are 10 beneficiaries, each are assumed to have a 10% interest. And thirdly, applying the if and when approach that allows, for example, the spouse with no interest to receive a portion of the beneficiary's interest when it is distributed in the future. So, evaluation relies on the individual assessment of the factors in each case to arrive at a fair and equitable conclusion. In mediation and arbitration, for example, the mediator will guide, for example, a divorcing couple by identifying the context and special circumstances of their situation and managing the problem solving on a dynamic basis. In matters of trust valuation, a mediator will enable the couple to manage the steps towards finding a fair resolution of the value to the trust interest, from gathering the proper documents to finding the right experts to complete the valuation. Because of the difficult nature of valuing trust, a cooperative process between the parties and their consultants and counsel reduces the likelihood of endless and costly legal battles and facilitates constructive communication, negotiation, and settlement. In the impacts of types of trust on valuations, I've put together a matrix which will help you to identify the types of trusts, whether it's income generating or not, and what is the appropriate valuation approach from a primary valuation approach perspective, and then finally the primary valuation method applied. For example, if the type of trust is testamentary with no income generation, the valuation approach could be either cost or market, and the valuation method, the preferred method, is the depreciated replacement cost method or the market price. If the trust is a charitable trust with no income generation, again the valuation approach is either cost or market. Again, the valuation method is depreciated replacement cost or market price. If the trust is an investment trust, for example, a property investment trust, and there's income generation, yes, the valuation approach is the income approach, and the preferred valuation method is capitalized earnings. If the trust is a business inter vivos trust and there's income generation, the valuation approach is income, and based on the volatility of future income, the valuation method is either capitalized earnings or present value of future earnings or present value of cash flows. If there's a special trust where the income is generated, yes or no, the valuation approach is the cost approach with a depreciated replacement cost as the primary valuation method. Session 3, Business Trusts and Valuations. What is a business trust? Well, first of all, a trust, as we've indicated in the definition, is a contractual arrangement that allows trustees to hold assets without owning them for the benefit of the trust beneficiaries. Therefore, most trusts are not business trusts, they are just used to hold assets. However, a business trust is a type of inter vivos trust that is formed to run a commercial business operation with a view to making a profit. In other words, a trading trust with a business profit objective. In the case of a living trust, that is the type of trust most likely to be encountered in this context, assets are initially provided by a founder, a settler or donor, and then owned, controlled and managed by trustees in their capacities as such, not in their personal capacities for the benefit of beneficiaries. The trustees can and usually do acquire more assets for the trust thereafter, again just to hold, control or manage. However, with a business trust, the trustees go one step further. They trade for a profit, again for the ultimate benefit of the beneficiaries. Trusts are therefore not separate legal entities like partnerships and companies, but in practice they are often treated as though they were. And some legislation, for example, the tax in particular, specifically defines them as such. And in terms of the New Companies Act, Section 1 of the definitions defines a legal entity, a trust as a legal entity, as a separate legal persona. Business trusts and valuations. The business trust value platform is either and or tangible productive assets, for example, plant, equipment, property, machinery, generating revenue streams, intangible productive assets such as franchise rights or software rights or royalties embedded in the intangible productive assets, and the construction of the trust balance sheet looks as follows. Starts off with non-current assets, for example, tangible productive assets, tangible property or land and buildings, intangible or tangible productive assets, current assets such as accounts receivable, inventories, cash in the bank, creates the total assets, less liabilities such as loan from beneficiaries, long-term loans for asset financing like installment sale agreements, current liabilities such as accounts payable or VAT payable for trading trust, gives us total liabilities, and the difference between total assets and total liabilities is the trust capital, including retained earnings where applicable, otherwise known as net asset value or trust equity. In relation to business trusts and valuations and tax implications, If the trust is a profit-making operation, it is fully taxed at the tax rate of 45% on the trust earnings, subject to whether the trust is a discretionary or non-discretionary trust. If the trust is not a profit-making operation or has been approved as a public benefit operation or organization with exempt tax status, it will be exempt from tax. However, whether one looks at a business trust, in either case, from a valuation perspective, we look at the future earnings based on a after-tax earnings position or performance. For business trusts for valuation purposes, we have identified certain key considerations. And these are 12 questions that needs to be addressed. Is the business and the trust a going concern? Very important, the going concern test. Secondly, does the trust meet the solvency and liquidity test at valuation date? Thirdly, what is the past performance track record? For example, past profits performance track record. Fourthly, what is the value platform? Is it tangible or intangible or a combination? Fifthly, what is the risk profile of the trust at valuation date in terms of succession planning, business continuity risk? What are the fair values, market values of all trust assets, excluding trading assets, where one looks at for example, inventories, which is 2 steps away from being converted into liquid assets, where one values it at the lower of cost or net realizable value. All other assets and liabilities are valued at market value. Question 7. What is the business model of the trust and the impact on future performance and growth prospects, including capital structure, financing, gearing structure? Question 8. What are the key assumptions needs to be factored in the valuation of the trust, e.g. tax rate, inflation, GDP growth rate of the particular country that one is looking at the trust? Question 9. Do operating expenses include trust administration fees? And are these expenses on an arm's length basis? Does the trust have a long-term strategy plan? Does it have a short-term business plan? Is the business trust geared with any gearing or leverage benefits in relation to bottom line performance? And finally, what is the cash flow of the business trust for the next 12 months in terms of cash flow from operations, cash flow from financing activities, and cash flow from investing activities? What are the advantages for forming a business trust? I've identified 5. First of all, perpetual succession. In other words, trusts like companies have perpetual succession, so they survive the death, incapacity, insolvency, or removal of trustees, with all the practical benefits that it entails. For example, the business can continue to operate normally after the death of the founder or trustees, rather than be tied up in the process of winding up of a deceased estate. And trusts that are properly created and administered can protect assets from creditors in the event of insolvency, divorce of the founder, trustee, or beneficiaries. Second question, benefit, advantage, the risk element. The risk of the trust belongs to the trust. In other words, business trusts, trading risks of the business, operational risks, for example, lie with the trust. That is, the trust assets are at risk from trading liabilities, not the personal assets of the parties to the trust. Trustees, unless, of course, they have signed personal suretyships for any trust deeds, generally risk personal liability only if they fail to comply with the provisions of the trust deed and other legal requirements, including negligence or gross negligence or acting fraudulently. In particular, they have very strong fiduciary duties towards beneficiaries and must always act in their best interests. They must also observe the fundamental requirement that trust assets be treated as such and not as their own personal assets. Third benefit, financing opportunities for trust. From a business trust perspective, as in the case with companies, one might find it easier to raise funding for a trust than for a sole proprietorship or partnership. Fourth benefit is tax advantages, depending on whether the trust is a discretionary or non-discretionary trust. And fifth benefit is savings on death. The trusts have in the past often been used to freeze the value of the growth assets as part of an estate planning exercise with a view to reducing estate duty, capital gains tax and executors' fees. These savings can be substantial, but beware of factors such as the high tax rates applicable to trusts and the various recommended changes to our tax and estate duty legislation, such as the Davis Tax Committee proposals, which could, if they are ever implemented, reduce the attractiveness of trusts for this purpose. What are disadvantages of business trusts? 3 possibilities. From a formation perspective, like companies, trusts require formal procedure for formation in the form of drawing up and registering the trust deed, appointment of trustees by the Master of the High Court. Factors resulting delays and costs into one's plans. However, we need to take shortcuts. An incorrectly worded trust deed, for example, will cause all sorts of unnecessary pain. Secondly, the cost of administration. Administration costs will generally be higher than with sole proprietorships, although typically lower than with companies. But one needs to check up front with one's advisors what you'll be in for. And then there's the possibility of tax disadvantages in terms of the tax rates for trusts vis-a-vis corporate tax rates, again depending on how the trust is structured around discretionary or non-discretionary trusts. Looking at some of the rules of trust taxation, we've identified the business trust and SARS valuation rules for trust. I call it the tax angle. Firstly, rule number 1, tax rate. As with all other possible trading entities that one can choose from, it is impossible to give general advice here. However, but as an overall comment, trusts have lost a lot of its favor and glitter in recent years as a result of various government attacks on trusts, and they are now highly taxed compared to individuals, partnerships and companies. In fact, government hates trusts. Apart from generally being subjected to higher rates of taxes, they are also denied the various tax exemptions and rebates available to individuals. Secondly, rule number 2, capital gains tax. Rule number 1, tax rate 45%. Rule number 2, capital gains tax effectively is taxed at 36% on capital gains. There are a host of factors to be considered here which needs to seek advice tailored to your particular circumstances. For instance, it may not affect your business trust that the primary residence capital gains tax exemption isn't available to trusts. Rule number 3, interest-free and low-interest loans. Government has given out strong signals that this hostile trend needs to be evaluated. In other words, interest-free and low-interest loans to trust have been subject to the risk of being taxed as donations. Now the conduit principle, whereby income can be taxed at personal rates in the hands of beneficiaries rather than the trust at a flat rate of 45%, is also under scrutiny. Fourth rule, business, trust and tax. Even more so than with other types of trading entities, it is essential to get specific guidance on whether a business trust is the most tax efficient entity for your particular situation on a sustainable long-term basis. When we look at the business trust deed checklist, I've identified essential elements that must form part and must be embedded in the trust deed of a business trust. The object of the trust or objects, for example, to operate for profit for the best interest of beneficiaries, how the trust property is managed and controlled, the borrowings and powers of the trustees in relation to borrowings, the power of trustees in relation to discretionary or non-discretionary trusts, the reporting requirements and reporting standards adopted by the trust, the audit of the trust's financial statements, remuneration paid to the trustee and reimbursement of expenses, the taxation of those trusts and supporting schedules, including schedules of beneficiaries, schedules of the business or corporate profile of the business trust, and details of the trustees. One provides it by way of schedules to the trustee so that any changes, amendments is requiring just an amendment to the schedules as opposed to the detailed trust deed body. Session 4, SARS valuation rules, including trust and tax. I've given you a market value of assets in a variety of circumstances matrix. In relation to capital gains tax, where it all started, the permanent market valuation rules, as opposed to the transitional market valuation rules on valuation date, are contained in paragraph 31 of the 8th schedule of the income tax as summarized below. In relation to the valuation date, and particularly when capital gains tax was introduced on 1 October 2001. Type of asset and market value determination. If it's a financial instrument listed on a recognized exchange, SARS rule is that the ruling price at close of business on the last trading day before disposal is applied. In other words, it doesn't look at the fundamental intrinsic valuation of the underlying financial instrument or the listed company. Any other assets, such as trust assets, its price is based on a willing buyer, willing seller at arm's length basis in an open market. As far as a business trust, the business is a going concern, fair market value on the same basis as defined in section 4, brackets 2, brackets B. Unlisted shares valuations, the rule is price based on a willing buyer, willing seller at an arm's length basis in an open market. And the valuation must reflect the extent to which a particular potential buyer of the shares can or cannot control or influence the company. There are many degrees of control or influence in a company. There are many degrees of control usually determined by the voting power of a particular block of shares, running from full control, including power to liquidate the company, to a small or non-existent influence over the company's affairs of a minority shareholding. It follows that unless there are exceptional circumstances, if the degree of control is less than complete, less than 100%, the value of shares will be less than the pro rata proportion of the overall value of the company. In terms of the definition of market value as defined in terms of paragraph 31, brackets 3 of the income tax 8th schedule, defines market value as when valuing shares in an unlisted company or a company not listed on a recognized exchange. No regard must be had to any provisions restricting the transferability of the shares. In fact, private companies, by definition, there is a transferability or liquidity risk in that you cannot advertise the sale of a private company's shares because by definition it is private. You can advertise the sale of the business out of the private company but not the private company shares per se. Also, no regard must be had to any provision, presumably in any agreement or in the memorandum and articles, which has now been superseded by the MRI in terms of the New Companies Act, which sets out how the shares must be valued. In other words, it needs to be done on an arm's length basis as opposed to either embedded in the MRI or embedded in a shareholders agreement. Again, from the rules of tax and trusts, we need to consider Section 4 of the Companies Act in terms of the solvency and liquidity rule. And Section 4 says in terms of assessing the solvency and liquidity of a company, one looks at the fair valuation of the company's assets and liabilities, including any reasonably foreseeable contingent assets and contingent liabilities, irrespective of whether or not arising as a result of the proposed dividend distribution or otherwise, and may consider any other valuation of the company's assets and liabilities that is reasonable in the circumstances, and we will address these valuation methods in this webinar. So, what is the summary for trust and tax? Here are the rules. In relation to different issues and events, the tax implication and tax rules. The founder's donation, in other words, ex-inheritance, ex-testamentary trusts, there is no donations tax but subject to estate duty application. Loans to trust by way of interest-free or low-interest loans to the trust is deemed donation, and loans to a company held by the trust, there's anti-avoidance rules that applies. For a public benefit organization earnings, where the annual trading income exemption applies, it applies to the greater of 5% of the total receipts and accruals, or 200,000, and the excess is taxed at the corporate tax rate of 28%. In relation to an inter vivos business trust profits, taxed at 45%. Distributions to beneficiaries, where the conduit principle and deeming provision applies, it's taxed in many cases in the hands of the donor. However, in terms of capital gains tax in a trust, there's a 36% effective capital gains tax, which is from a calculation is 80% times 45% maximum marginal individual tax rate. From a valuation and tax application, we've looked at different applications. We've identified the authority and the valuation basis. For example, capital gains tax, the authorities, Income Tax Act, Section 26 and 8 Schedule, the disposal value of the fair market value or deemed disposals is the basis of capital gains tax. Donations, there's donations tax, and the donations tax where donations is made at not adequate consideration, that is fair market value, or in case of immovable property or farm property, donation is based on the fair market value less 30%. So from a donations, where the donations tax, where the donations is not adequate consideration, that is, it's based on fair market value. Estate duty, in terms of Estate Duty Act Section 5, the estate duty is based on assets at fair market value or disposals value, whichever case applies. And in case of immovable property or farm property, the estate duty is based on the fair market value less 30%. Transfer duty on immovable property in terms of Transfer Duty Act Section 5 is based on the disposal value or fair market value, whichever is the greater. Security transfer tax for listed shares, unlisted shares, and closed corporations members' interest in terms of the Securities Transfer Tax and Financial Act. It's based on the consideration, that is the disposal value or closing price or fair market value of securities transferred, whichever is the greater. And finally, in terms of a business trust that's earning earnings, income tax on earnings in terms of the Act is based on, from a valuation perspective, valuation is based on the net profit after tax. So, in summary, what is the position on trust and tax? These are the rules. An inter vivos trust is taxed subject to the provisions of Section 25B and Section 7 of the Income Tax Act. Section 25B is the principal taxing section relating to trust. In essence, the section provides that the income of the trust is taxed either in the trust or in the hands of the beneficiaries. If the income vests in the beneficiaries, they are taxed on it. If the income does not vest in the beneficiaries, the trust is taxed on it. So, from a caveat perspective, in relation to Section 25B, subject to Section 7, if Section 7 applies, some other person, e.g. the donor, may be taxed instead of the trust or the beneficiaries. Now, in terms of the types of trusts and how it influences taxation, as far as discretionary trusts, this type of trust gives the trustees the discretionary powers as to how and when to allocate the income or capital of the trust to beneficiaries. The trust is taxed on income, is trust at 45%. A vested trust, the trustees are not given any discretionary in the deed and trust deed, and the beneficiaries and their benefits are fixed and predetermined. The beneficiaries are taxed on income, and consequently there is no taxes that's been applied to vested trust at the 45% rate. However, from a caveat purpose, very, very important consideration for valuation purposes, to get to the value of the business core operations for both a discretionary trust and a non-discretionary or vested trust, the net profit before tax is taxed at 45%. That is to get to an after-tax basis. In other words, the beneficiaries' distributions has to be added back and normalized. So normalized earnings is to achieve the level of playing fields so that one can value a business operations, leveling the playing fields, ignoring the beneficiaries' distributions and tax shield, and every business, whether it's discretionary or non-discretionary, is being taxed on the same pre-tax profits, if you're looking at comparing apples to apples. So the question is, how does business trust come into play in relation to the sale of the trust, equity or capital, vis-a-vis or compared to the sale of the business assets out of the trust? Firstly, sale of individual assets out of the trust, that is investment shares owned by the trust or the value platform or infrastructure business assets. And secondly, the sale of net assets of the business, that is the gross assets less liabilities. And the answer is yes, one can sell the individual assets out of the trust if it's in the best interest of the beneficiaries. However, one can never sell the capital or notional equity of a trust. For information purposes, we give you the ruling in terms of income retained in the trust and tax applications. And this ruling and the example is with the complements of Notes on South African Companies Act that has been written by Professor Philip Haupt. Where income is retained in the trust, it can be taxed either in terms of Section 25B, in which case the trust will be taxed, or in terms of Section 7 brackets 1, in which case the beneficiary will be taxed, or in terms of Section 7 brackets 5, in which case the donor will be taxed. 3 scenarios. Only if Section 7 brackets 1 or 7 brackets 5 do not apply will the trust be taxed on the income. This is because Section 25B is subject to Section 7. And Section 7 brackets 1 applies where the beneficiary has a vested right to the income retained in the trust. In other words, the beneficiary is certain to get the income at some time in the future, only his enjoyment of it has been postponed. If he or she dies before the income is paid out to him, it will go to his estate. Therefore, as the income is effectively the beneficiary's and nobody else, he will be taxed on it. However, a vested trust must be distinguished from a contingent right. If a beneficiary has a contingent right to income, it is not certain that he will ever receive the income. Therefore, he cannot be taxed on it. This would be in the case, for instance, where a trust deed provides that if one beneficiary dies, the accumulated income of the trust will be given to the other beneficiary, or where the trust deed provides that trustees may pay out the income or accumulated income of the trust to the beneficiaries in whatever proportion they see fit. However, Section 7(5) applies to income which accrues to or is received by the trust and which is not paid out to the beneficiaries as a result of a stipulation in the trust deed which prohibits the payment to the beneficiaries, unless the happening of some future event. The important point is that Section 7(5) only applies in instances where income accrues to the trust and is not distributed to the beneficiary. One further requirement is that, but for the stipulation, the income would have been received by or would have accrued to the beneficiaries. Where the income is not paid out but vests in the beneficiaries, the second requirement is not met and Section 7(5) cannot apply. In tax court decisions, the court found that where the beneficiaries had a vested right to the income, such income accrued to the beneficiaries in terms of Section 7(1), notwithstanding that the fact that the income was not actually paid out to them. Where, however, income has been retained in a trust and such income does not vest in the beneficiaries because of a stipulation or condition, the beneficiaries cannot be taxed on such income. Section 7(5) will then operate to tax the persons who made the donation or disposition to the trust on so much of the income retained in the trust or as arises out of the donation or disposition made by that person. Now let's look at an example in terms of Section 7(5) and the conduit principle. For example, Mr. Smith forms a trust for the benefit of his 3 children and has a stipulation in the trustee that each beneficiary will be paid $30,000 annually and that the balance of the income shall not be distributed to the beneficiaries until the youngest, now age 16, reaches the age of 21. The trustees have a discretion to distribute the income in any proportion on that date to the beneficiaries. The 2 other beneficiaries are 22 and 24 age respectively. All beneficiaries are South African residents. The trust assets comprise a block of flats introduced into the trust by Mr. Smith and 1 million rands cash introduced by his mother. During the first year of the following income is received by the trust: rentals from the flats 500,000, interest on call accounts in relation to the investment of 1 million rands, 100,000, totaling 600,000 in the first year. What income will be taxed in the respective parties and in relation to the following way? Firstly, the 2 beneficiaries who are over 21 will each receive 30,000 rands, of which 25,000, 5/6 of 30,000 is rent and 5,000, 1/6 of 30,000 is interest. The full 30,000 will be gross income in their hands. However, the interest portion is subject to an interest exemption. Secondly, the youngest beneficiary receives the same amount, not in terms of Section 7(3). The 25,000 rent portion is deemed to be Mr. Smith's income and will be taxed in his hands. The balance of 5,000 being the interest proportion or portion is not subject to Section 7(3) and is included in the beneficiary's gross income and is subject to the interest exemption. Thirdly, the amount which remains in the trust because of the stipulation that is taxed in terms of Section 7(5) is as follows: trust income 600,000, amount distributed 90,000, 30,000 times 3. The balance that is not distributed is 510,000. The rent portion of this balance, namely 425,000, that is 5/6 of 510,000, will be deemed to be rental income in Mr. Smith's hand and will be taxed on it. Session 5. Business Trust Valuation Equation. What does it look like? Where does it start? First of all, identifying the carrying values in relation to the particular assets and liabilities that forms part of a business trust construction, and then asking two critical questions. In relation to the carrying value, does the trust meet the solvency liquidity test at carrying value or not? If not, we need to look at the fair values, and does the trust meet the solvency and liquidity test at fair values? Then, second question, is the business trust a going concern? And that impacts on the valuation method as well. Now, the business trust valuation equation, first of all, identifies the core business valuation platform. In other words, the valuation of the business, the core business, on a fundamental basis, and how does that compare to fair values and carrying values. And then secondly, it then looks at the other non-fundamental productive assets in terms of fair value, for example, land and buildings, current assets, loans from beneficiaries, loans from financiers, total long-term liabilities, current liabilities, and then total assets less total liabilities in terms of our trust capital valuation based on the core business operations, non-core business, and our total fundamental capital trust valuation compared to our carrying values. That is the business trust valuation. In other words, there's a two-step process. First of all, valuing the core business operation, and then getting to a trust capital valuation on a fundamental basis. Session 6, the business trust valuation process. As we mentioned earlier, it's a two-stage process. First of all, the valuation of the business enterprise or the business operations, identifying core business operations and non-core. And if non-core is critically important, it needs to be valued also on a fundamental basis. Core business operation is valued on the fundamental basis in relation to the enterprise valuation and enterprise operation. To that core business and non-core business operations, we add any other assets, for example, property investment, land and buildings, current assets to get to our gross assets, less the total liabilities, e.g. loan from beneficiaries, other long-term loans, and less current liabilities to give our bottom line net asset value, equity valuation, trust capital valuation on a fundamental basis. What are the rules, the valuation rules, and the valuation considerations? I've given you a matrix where we focus on the valuation considerations, which applies or not applicable, and then the valuation rules. For example, a business trust, we need to identify whether it is a non-discretionary or vested trust or a discretionary trust. In relation to the business trust, the valuation rule is valued on a fundamental intrinsic basis for the core business operations, and in particular looking at the going concern. Non-business trust, whether it's vested or discretionary, the non-business trust value is embedded in the assets at fair market value. We then need to ask the question, particularly in relation to the valuation of a business trust, is it a going concern? If it's not a going concern, we value on the intrinsic cost approach and method. If it is a going concern, we value on an income approach. What are the ownership rights of the business trust? It then influences our value platform or the infrastructure or the source of revenue creation. We look at the value rights attached to the ownership rights, and we establish our value platform, and we establish and identify the revenue streams that's emanating from the infrastructure or value platform. The economic life of a business trust is normally capped at a maximum of 15 years in relation to the fact that any earnings and cash flows after the 15 years, on average, if it's discounted to present value, creates a nil present value of those cash flow or earnings. The risk profile of the business trust needs to be identified, and that needs to be computed, because that forms the basis of our build-up method to compute our discount rate. Then, if there is commercial property owned by the business trust from which it operates, we need to create a notional landlord, notional tenant, and a notional rental agreement, so that the business valuation is valued on an arm's length basis in terms of the rental cost, and the property, commercial property in the trust, is valued on an arm's length market-related rental basis. The business trust framework consists of identifying and starting off with the business trust valuation, trust business valuation. Then we're looking at the issue around the taxation of income from the business trust, and where it applies is taxed at 45 cents in the rand. Then our third element is the trust equity or trust capital valuation, based on whether the trust is discretionary or vested trust that will influence the bottom line of the trust capital valuation. And when we do the cases of the business trust for discretionary and non-discretionary trust, we'll see the fundamental difference in that trust capital bottom line computation. Session 7, Business Trust Valuation Platform and Business Trust Value Drivers. What is the valuation platform of the business trust? It's consisting of two elements: the tangible assets, intangible assets, and focusing on productive tangible assets, productive intangible assets, those assets, infrastructure, whether tangible or intangible, that is creating a revenue streams in its own right or on a composite basis. So productive tangible assets, for example, a trust that is a manufacturing operation, the main one is plant and equipment. If the trust is the human capital, for example, franchise rights, software, those intangible assets are the source of revenue generation. They are the value platform. And ultimately, the value platform is going to be valued on a fundamental intrinsic basis to get to our core business operational valuation. If we have any non-productive tangible assets, non-productive intangible assets, it needs to be valued either on an intrinsic embedded cost basis or on a fair market value basis between a willing buyer and a willing seller. The business trust value drivers, in line with most business operations value drivers, are, for example, margin in a trading business, cash flow, in particular cash flow from operations, expense management and expense reduction, the client customer base and supply base, and the quality of our management vis-a-vis the executive management, and also the management by the trustees. Business trust valuation assumptions looks at the future growth rate in terms of future sales, growth rate of gross profit, growth rate in terms of gross margin percentage, and growth rate in overheads. Is it sustainable, maintainable, and realistic? And how do we benchmark it in relation to the past performance and future prospects? If we're looking at a gearing position, we need to identify the cost of debt, which is embedded in the interest rate on our debt finance. Our trust tax rate, currently at 45%, applies to the taxable earnings of the trust where applicable. We are concerned with the South African economy's GDP rate, which is going to influence our differential between our discount rate and capitalization rate, presently at 7%, if we round up, for example, to 1% for the next 12 months. Where we are a business trust, a trading trust, which involves inventories and debtors and creditors, we need to consider the change in working capital percentage, how it impacts our computation of our computation of our free cash flows. And finally, the computation of our discount rate starts off with our risk-free rate. For example, the R186 Treasury bonds currently at approximately 6% after tax. Our market expected rate of market expected risk premium, and then looking at the business specific risk as well. And then on a fundamental basis, we're also looking at the issue of the business trust in terms of whether it has to be penalized around the transferability of the assets, and as indicated, the transferability and liquidity risk component from a SARS point of view needs to be excluded when it looks in terms of the SARS rules. What is the economic life of a business trust? As we mentioned, the computation is based on an estimated 15 years economic life, as mentioned, because thereafter all future earnings, future free cash flows discounted to present value creates a null present value position. However, the economic life of a business in terms of the realities needs to be identified. For example, if the business has reached the end of its economic life and has to be sold or closed down, the trust will carry on, subject to the trust deeds and condition in relation to the administration of any other assets. In other words, not business-related assets remaining in the trust. However, where the trust deeds identifies a trust condition that applies to termination, one needs to take this condition into consideration. For example, if the trust has to be terminated as a result of the termination condition and the business is still a going concern, the business will have to be sold out of the trust as a going concern. Session 8, Business Trust Valuation Methodology. Like any other business, the business operations of the trust will be valued on the appropriate valuation method based on the appropriate valuation approach. 3 valuation approaches. First of all, cost approach. That is based on fundamental intrinsic asset cost method or the depreciated replacement value method. If earnings approach applies, then we're looking at the earnings platform, the volatility of the earnings, the period enjoyed future earnings period, whether it's a fixed period or fluctuate, or whether it's in perpetuity, and that's influenced by the business life cycle and the product life cycles. This influences the appropriate valuation method, whether it's capitalized earnings, present value of earnings, future earnings, or discounted cash flows or discounted free cash flows. The market approach recognizes in a particular industry sector there are benchmark transactions. For example, in the fuel service station is benchmarked in terms of liters pumped. In franchise operations, one can benchmark your franchise operations valuation in terms of other franchises in the same sector that has been sold, and also the going concern basis influences whether an income approach will be used or not, as opposed to the market approach. Very important decision in valuations is what is the appropriate correct valuation method that forms the basis of the primary valuation method to be applied to the valuation of the business operations. And the decision will be based on 4 critical considerations. Is the business capital intensive? In other words, substantially driven by the infrastructure of plant and machinery and equipment. For example, if you're looking at a mining operation, very much capital intensive. If we're looking at value added, converting coal to anthracite, you have a plant that you have to invest in, capital intensive. Earnings volatility, in terms of whether the future earnings is growing by a constant rate or fluctuating. Future earnings, is it going to be enjoyed in perpetuity, in other words, forever, around the 15-year life cycle, or is it going to be earned for a fixed period, for example, the next 3 years or next 5 years, based on the firm contractual commitments where there's no certainty around renewal dates? And then, again, in terms of earnings for fixed period. How do we convert this matrix into terms of practical decisions? Well, for example, the trust valuation method for a business trust that is not a going concern, we use the intrinsic asset valuation method, that is the value of all assets of the trust at fair market value, other than if in a trading trust inventories are valued at the lower of net realizable value or cost. If the trust business is a going concern, we've identified the valuation method decision matrix, and it recognizes the nature of the business around key elements. 4 alternative valuation methods, for example, capitalized earnings, present value of future earnings, discounted free cash flow without terminal value, and discounted free cash flow with terminal value. So a capital intensive business, the primary valuation method will probably go either the discounted free cash flow with terminal or without terminal value. If the business has future earnings growth that is volatile, present value of earnings, future earnings will come into play. If the future earnings growth is constant, capitalized earnings method comes into play. If the future earnings is for a fixed period, either the present value of future earnings or discount free cash flow without terminal value comes into play. And finally, if the future earnings is in perpetuity, either the capitalized earnings method or discount free cash flow with terminal value comes into play. So, however, those considerations needs to be linked up. It's not just simply taking one particular element and that becomes the defining decision around the valuation method. So, for example, if we take the matrix to a practical example, the business trust that we're going to value is a going concern. Is it capital intensive? No. Is the earnings volatility there? Fluctuating? Yes. Is the earnings scheduled to be in perpetuity because of the nature of the trust deed, vis-a-vis the condition in relation to termination, in relation to the business model, in relation to the track record? Earnings in perpetuity? Yes. Is the earnings for a fixed period? No. Consequently, if we look at capital intensive, it doesn't apply. Future earnings growth is volatile? Yes. Then the discounted free cash flow with terminal value is a possibility. If the future earnings growth is constant, there's no valuation method applicable. If the future earnings is for a fixed period, it's not the case because it's in perpetuity, no valuation method is applicable. If the future earnings is in perpetuity, yes, the discounted free cash flow with terminal value will apply. In relation to this example, because the business is not capital intensive, one would then be looking at present value of future earnings, but because the earnings is for in perpetuity with earnings volatility, the primary valuation method would be discounted free cash flow with terminal value. Discounted free cash flow with terminal value. Session 9. Business Trust Valuation Case Studies. Let's look at case study number 1. It's a valuation of a business trust, a commercial operation called Afri Clothing Trust. There's a trust number. SA Trust manufactures and exports beach clothing on a global basis. It's got global distributors and it's South African based. The starting point is the balance sheet at 31 October, the valuation date being 31 October 2018. We identify the carrying values, in other words, the book values of our tangible productive assets, which is plant and equipment, trademarks and patents, current assets, deferred tax, total assets, long-term liabilities, loan from beneficiaries, current liabilities, total liabilities, and the trust capital net asset value at carrying value. We also identify the fair values of our productive assets, and we'll see it's 8 million as opposed to 5 million, trademarks 2 million as opposed to 1, current assets is at the same embedded cost of 50 million, deferred tax doesn't come into the equation because we have identified and capitalized our productive assets at fair value. We've got total assets at fair value of 25 versus 22 million carrying value. Our total liabilities at fair value is 13 million, and that's the same at carrying value. And we've got our trust capital at carrying value at 9 million versus fair value of 12 million. But what is the fundamental intrinsic valuation of this business operations being manufacturer and exporter of beach clothing? And we look at assuming that this trust is a non-discretionary trust, and we're looking at the historical earnings for sales at the year ended 31 October 2018, our trading results, and we see the sales level, cost of sales, gross profit, less OPEX, marketing costs, EBITDA, depreciation, interest on loans, net profit before distribution and tax, and by virtue of it's been non-discretionary trust, there's no distributions that's going to have a tax benefit, and therefore the net profit before tax is taxed at the full trust tax rate of 45%, leaving us with a net profit after tax at 11.6 million. How does this impact the valuation of the trust business and trust equity? The assumptions is that the future earnings will grow at a constant rate of 20% after tax on a year-on-year basis. We've computed the discount rate to be 21% and the capitalization rate is 20%. Our primary valuation method based on our scorecard and metrics is capitalization earnings method. The projected net profit after tax for year plus 1, because we're valuing the future, not valuing the past, is 11.6 million, growing at 20%, gives us a 13.9 net profit after tax. Capitalizing it at 20% gives us a business core operation valuation of 69.6 million. If it's a non-discretionary trust, the valuation balance sheet looks as follows. We're looking at tangible productive assets on a fundamental intrinsic basis. Fair value is 8 million, trademarks and patents 2 million, but the total trust core business valuation is 69.6 million per calculation, which means our economic goodwill is 59.6 million. Our current assets are 15 million, no deferred tax on fundamental valuation, less long-term liabilities, less current liabilities, and we get to a trust capital net asset valuation of 71.6 million. 71.630 thousand in relation to a non-discretionary trust valuation for this particular entity. Now, case study 2 is we look at this company and we assume that it's part of this trust, and we assume that it's part of a discretionary trust. It is a discretionary trust in terms of the trust deed. Our income statement results for the year end is the same at EBITDA level and at net profit before distribution and tax. And we look at our available resources in terms of liquidity, and we see that there is approximately, in current assets, we got 15 million and liquid assets at 10 million. So we are restricted in our distribution to it from a cash flow perspective in terms of our distribution to beneficiaries, which we could obviously distribute more, but we can't pay out more in terms of our liquidity restrictions. So we've distributing to beneficiaries 10 million. Net profit before tax is 11 million, and we've got the tax shield of the distribution to beneficiaries, resulting in a tax expense and liability of 4.9 million to give us our net profit after tax of 6.1 million, compared to a non-discretionary trust that was coming out at 11.6 million after tax. We now are able to value our discretionary trust, the business operations, and the capital net asset value of the trust. Same assumptions in terms of the growth rate, same discount rate, same capitalization rate, same risk profile, and same primary valuation method, capitalized earnings. And in relation to the valuation of the core business operations, whether it's a discretionary trust or non-discretionary, we have to level the playing fields. We have to do a normalization and adjustment exercise on the earnings after tax, and this requires net profit before tax, add back the distributions of 10 million, gives us a normalized net profit before tax, less the tax at 45%, and we got an adjusted normalized net profit after tax at 11.6 million, capitalizing at the capitalization rate of 20%, and we get an exact same business valuation for the trust, whether discretionary or non-discretionary. However, this is where the similarity ends. Where does the difference lie? It lies in the final computation of our equity capital trust valuation in relation to discretionary or non-discretionary. From a discretionary perspective, we got our carrying values as previous, we got our fair values as previous, but if we look at the core business valuation, it's previous, same current assets, no deferred tax, same long-term liabilities. In terms of our loan from beneficiaries, that could have changed if we had distributed more profits to the beneficiaries and not paid it out the equivalent amount. It's now reflected at 5 million, and we're going to look at the reconciliation of that. Current liabilities are the same, but our trust capital NAV valuation is on a fundamental basis for a discretionary trust due to the tax differentials between discretionary and non-discretionary trusts, results in a trust capital valuation for a discretionary trust at 61.6 million as opposed to the 71.6 million. If we look at our computation of our loan from beneficiaries, the reconciliation, we started off with a 5 million loan from beneficiaries. We distributed 10 million. We've paid out 10 million, and it's the loan from beneficiaries closing balance remains at 5 million. In summary, we need to, as part of our trust valuation computation, always consider the trust due diligence, particularly the trust due financial diligence, and to this extent 12 questions need to be asked in relation to a trust due diligence. Question: what are all the legal and statutory requirements of the trust? Has that been met? What are the tax implications and how is it applied according to the structure of the trust? Who qualifies to act as trustees? How are trustees elected and selected? Should there be a trustee induction program? What authority do trustees have? What are the responsibilities of trustees? What are the principal roles of trustees? How does one measure the effectiveness of the board of trustees? How are the funds controlled and protected? What investment principles should be followed? And how should a trust be valued? For your information and edification, we supply you with the Trust Property Control Act in a nutshell and a detailed Trust Property Control Act, Act 57 of 1988, in the South African context as amended. From a nutshell perspective, Trust Property Control Act, vital sections: Section 4, trust deed to be lodged with a master. Section 6, written authorization to act as trustee to be given to master. Section 9, due care, diligence and skill required by trustee. Section 10, the trust bank account. Section 11, separate identification and registration of trust assets. Section 12, trust property should not form part of the personal estate of trustees. Section 15, reporting irregularities by trustees. Section 19, the failure by trustee to account or perform duties. Section 20, the removal of trustees. And Section 21 is the remuneration of trustees. Now we move to our value-added component in this webinar called to How to Value a Trust Literacy Test. How literate are you on valuations of trust? 10 questions on trust valuations. Question 1. How does the market valuation of trust assets differ from other entities? A. It is based on the CMA valuation. B. It is based on the transaction price. C. It is based on the trustee's valuation. D. It is based on fair market value applying to all assets. E. All of the above. And the answer is D. It is based on fair market value applying to all assets. Question 2. How does a discretionary trust impact on valuations? A. Same as all trusts. B. Same as vested trust. C. Same as non-discretionary trust. D. Depends on distributions to beneficiary. E. Tax relief on distributions. And the answer is D. Depends on the distributions to beneficiaries. Question 3. How does a non-discretionary trust impact on valuations? A. Same as vested trusts. B. No tax relief on distributions. C. No tax relief because there are no distributions. D. Same as all trusts. E. All of the above. And the answer is C. No tax relief because there are no distributions. Question 4. How does a vested trust impact on valuations? A. Same as a discretionary trust. B. No impact on valuations. C. Depends on which business trust is a going concern. D. Depends on whether the trust is a business trust or not. E. All of the above. And the answer is C. Depends on which business trust is a going concern. Question 5. When does a business trust not pay tax? A. When it makes a loss. B. When it is a discretionary trust and distributes all profits to the beneficiary. C. When it is not a going concern. D. When it has computed tax loss greater than current profits. And E. All of the above. And the answer is E. All of the above. Question 6. When does a business trust pay tax? A. It has taxable profits. B. When it is a going concern. C. When it has no computed or assessed loss. D. When it does not distribute profits to beneficiaries. And E. All of the above. And the answer is E. All of the above. Question 7. What are the risks related to a business trust? A. No business continuity plan, no succession plan. B. Overspending by trustees. C. Not considering the needs of beneficiaries. Poor investment management. E. All of the above. And the answer is E. All of the above. Question 8. What is the value platform of a business trust? A, the trust deed. B, the trustees. C, the productive tangible assets. D, the productive tangible and productive intangible assets. And E, all of the above. And the answer is D, the productive tangible and productive intangible assets. Question 9. What are the main value drivers of a business trust? A, trustees' performance. B, business model of the trust. C, annuity income in the trust. D, cash flow from operations. E, all of the above. And the answer is D, cash flow from operations. Question 10. When should an income valuation approach be considered in valuing a business trust? A, it is never required. B, it depends on whether the trust is making a profit or loss. C, it is based on whether the value platform is productive. D, it is based on the assets of the trust. E, it is based on the trust deed. And the answer is B, it depends on whether the trust is making a profit or loss. Question 11, your bonus question, the last chance to pass. When should the cost approach be considered when valuing a business trust? A, when the trust has tangible assets. B, when the trust is solvent. C, when the trust is liquid. D, when the trust assets are not income generating. Or E, all of the above. And the answer is D, when the trust assets are not income generating. Ladies and gentlemen, thank you for your participation, and we are now going to proceed with how to value a trust, a question and answer session. And it gives me great pleasure to invite Advocate Lee Jeffer to join in the Q&A session. Question: what does at arm's length mean, and how do you apply and ensure this? At arm's length means in relation to revenue or expenses, that the expenses on revenue must be reflected on an arm's length basis, which means on a market-related basis. In other words, you can't understate rental cost or any expenses, salaries, because the decision is to charge a rental at underrated or overrated market-related costs. So in relation to critical expenses like employment costs, particularly around the owner-managed position, or in a trust situation where the trust has its own property or operates from its own property, one needs to make sure that the rental on a notional rental between notional landlord and notional tenant is market-related. That is arm's length. Question: may a trustee and a beneficiary be the same person? Yes, but in terms of the checks and balances and in terms of good controls and good governance for trust, the one needs to have an independent trustee that is neither a beneficiary or the founder of the trust.
It is also important to remember that the founder of a trust may also be a beneficiary.
Question: may the business value of the trust be a beneficiary of the trust? Yes, the business valuer may be the beneficiary, but again, the control mechanism is an independent trustee that evaluates the competence, experience, qualifications, and the valuation computation by the business valuer, so that there is no manipulation or corruption or distortion around the business valuation of the trust. Question: is a beneficiary permitted to cede his or her rights as a beneficiary?
Yes, any rights of a beneficiary, even discretionary rights, can be ceded, provided, of course, that this would not be prohibited by the trust deed itself. In a so-called business trust, the trust deed will usually be specific and allow a beneficiary to cede or otherwise dispose of his rights in the trust.
Question: what can a trustee do to create or increase the value of the trust? Like any commercial operations, like any investment asset, a trustee needs to first of all protect the assets of the trust and then have a strategy and a plan of action that is in the best interest of the trust and the beneficiaries, that is not reckless trading, and that looks at the risk profile of any opportunities to increase the value of trust assets or increase the value of the business if it's a business trust.
A great advantage of a business trust is that the trust holds out the possibility of a limited liability form of trading without the complexities or expense inherent in trading through a company or a close corporation. Beneficiaries of a trust as beneficiaries enjoy limited liability and are not exposed to business risks and failures. However, the same cannot be said of trustees because they are not immune from personal liability if they are reckless or fail to show the required duty of care and skill. The danger of a trading trust is that such a trust could be regarded as a partnership because all the elements of a partnership are often present in such a structure.
It's further to add that the principal source of value creation for a trading trust or business trust is the earnings or net profit after tax. And we've identified in the webinar the value drivers that will positively and fundamentally contribute to growing the bottom line of the trust and ultimately increasing the value of a business trust. Question: you mentioned 4 instances where a trustee controls a trust. Must all 4 requirements be met or any one of the 4 in order to take control? Yes, absolutely, all 4 requirements needs to be met.
In order to avoid the trust being regarded as a partnership and not as a trust, it is important for the trustees to be persons independent of and different persons from the beneficiaries. Care must also be taken in the case of a trading trust to ensure that beneficiaries are not seen as the owners of the properties subject to the trust. If the terms of the trust deed are interpreted to indicate that the beneficiaries have ownership, it is submitted that it would then be open to treat the trust either as a Bevin trust or as a partnership. This could be very important or an important factor in the event of the failure of the business venture or if a particular beneficiary went insolvent, because any asset belonging to a beneficiary would fall into that beneficiary's insolvent estate and be subject to the claims of creditors.
Question: what is the main difference between valuing a business trust than valuing any other type of trust? So, valuing any other type of trust, the focus is on the growth in the investment assets or tangible assets like land and buildings. So the valuation focuses on the growth in the balance sheet of the trust. But in business trusts, the valuation focuses on increasing the performance of the income statement of the business trust, namely in terms of performance, in terms of sales, revenue growth, expense management, and bottom line profits pre or post-tax. Furthermore, also in terms of the valuation methodology, in most trusts other than business trusts, the valuation methodology is around the fundamental intrinsic value of the assets and the market value on an arm's length basis between a willing buyer and a willing seller. And the valuations of business trusts is very much around on the assumption that it is a going concern generating future revenue. It's based on the valuation method of income-based valuation method. Question: what if trust assets are not registered in the name of the trust in relation to the valuation of that trust? The trustees need to confirm one can only value the trust whether if the assets are registered in the trust or whether the trustee has acquired the assets on behalf of the trust, and that is absolutely evidential in terms of documentation and an agreement between the trustee and the trust. However, from a protection perspective, from a risk perspective, it is not recommended that trust assets be not registered in any other entity than in the name of the trust.
It must be remembered that a trustee usually cannot expose trust assets to business or other risks, because this would be in breach of a trustee's fiduciary duties. However, a trust deed can expressly give a trustee powers to carry on business or to trade. A business or a trading trust is valid in law, provided that the trust deed itself empowers the trustees to carry on business or to trade. This in itself implies that such trustees are entitled to expose trust assets to ordinary risks associated with the authorized type of business or trade. For example, a realization trust, which is a specific type of business trust, is formed with the specific intention of developing and then selling immovable property, and the trustees are given every power in order to make this goal achievable. The trust is therefore the vehicle through which the property is realized.
Question: can one have a minority or majority trust valuation? Subject to the trustee's authority and responsibility in relation to a discretionary trust, there could be numerous beneficiaries who are, in some cases, are majority beneficiaries, and in some cases, minority beneficiaries, and it's therefore one's able to value the trust capital on a 100% basis and then break it up in terms of a minority beneficiary or majority beneficiary according to the interpretation of the trust deed, how it sets out the position of minority or majority trust beneficiaries. Question: can one value a trust for a particular beneficiary's interest only? Yes, once one has determined the 100% total capital trust valuation, one can then identify a particular beneficiary's interest, again subject to the affirmation around the trust deed. Question: what if the business trust has not yet started trading in relation to the valuation of that trust? If there's no absolute 100% certainty of future revenue flows going into the business trust in terms of a new business trust or trading trust, then it can only be valued on the basis of embedded costs, whether it's a tangible or intangible assets, or the fair market value of those tangible or intangible assets between a willing buyer and willing seller. Question: how do you calculate the discount rate for the business trust? In line with business, commercial business, whether it's incorporated as a company or close corporation or even sole proprietors and partnership, one looks at the discount rate based on a build-up method using the risk-free rate on an after-tax basis, the market expected risk premium, and also looking at the business-specific risks. In terms of SARS rules, one needs to exclude any saleability and liquidity risk around the discount rate computation. Question: what is the difference between a license agreement and a user agreement? What is the difference between a license and agreement? Well, first of all, a license is part of an agreement with specific rights to operate. For example, like a franchise agreement is really a license agreement. A user agreement is really principally around a specific asset that has been made available that you can use. For example, a photocopy machine or a vehicle or other tangible asset. Question: Do you always need to calculate the business assets of the trust separately from its capital equity? Yes. To get to a capital equity calculation for a business trust, the first step is to value the intrinsic value of the operation, which is the tangible and intangible productive assets. Thereafter, the equation goes into looking at the non-productive tangible and intangible assets, including current assets, less all liabilities, to get to a capital equity valuation for the trust. One can never ever go straight into a capital equity valuation for a business trust. Question: how do you value with a trust with no assets? One needs to identify, for example, first of all, one cannot have a trust with no assets. By virtue of the formation of the trust, there has to be a capital contribution by the donor or founder or sponsor, whether it is 100 rands or 200 rand initial contribution. That would be effectively the first asset in the trust. Thereafter, depending on any distributions or any donations or loans to the trust, assets will be built up. If it's a business trust, one might have an intellectual property component that has not been capitalized by way of a loan from a third party, or a loan from trustees, or a loan from beneficiaries, and that needs to be accounted for so that one can then value the trust with or without any tangible assets, any intangible assets, or with tangible and intangible assets. But certainly there can never be a situation where there is no assets. Question: what if the business trust assets are depleted, used, sold? What is the value of the trust then? Well, one looks at if the business trust assets are depleted, used or sold, or there's a negative value, one then needs to look at the solvency of the trust. But if there is a positive value, one needs to, in terms of what rights are embedded in the trust, one also needs to look at any other assets in the trust in relation to investment assets, current assets, financial assets, less liabilities, to get to the value of the trust capital. Question: how do you determine the business model of a particular trust? One needs to look at the nature of the business, and with regard to its goals, objectives, its structure, its organization, its target market, customer base, supply chain, standards, systems, reporting structures, management, and trustees. These are elements form the business model of a particular trust, and in particular a business trust.
A trust can in fact be structured in such a way that ensures that it resembles a company or a close corporation. Trustees can be given most of the powers of a director or member, and a beneficiary can be given rights that are similar to those of a shareholder or member, including the right to sell or otherwise dispose of his interests in the trust. In a business trust, beneficiaries are often issued with a certificate of interest in the trust, giving details of the rights of beneficiaries and certain other details, such as the reference number of the trust.
Question: how do you determine the value platform of a particular trust? In relation to the business trust, one looks at the business model around its goals, objectives, and the mission and the purpose of the business, and one identifies the infrastructure that is the source of revenue creation. That is the value platform, and it can be a combination of a tangible and intangible productive assets. Question: can I use your online valuation tool, onlinebizvaluations.com, to value a business trust? Yes, one can use it in relation to the valuation of business trusts. Question: will you be able to assist me with the valuations of clients of mine with the business and non-business trusts, or provide a review of my valuation? It will be an absolute pleasure to assist you in that valuation process, and if necessary, if you like to consider the option to outsource your valuations of business and non-business trusts, it would be a great pleasure to assist in that regard. Now it gives us great pleasure to announce the winner of our electronic lucky draw, and the prize comes on offer is the questions and answers for accounting officers and members of CCs on the Companies and Amended Close Corporation Act, written by Dr. Advocate Lee Jeffer, and also Vrouw en Antwoorde vir die Suid-Afrikaanse Maatskappywet, written by the same author. And the winner is Mr. Joseph Erasmus Pretorius. Joseph, congratulations, and your prize will be sent to you by courier in the next 48 hours. Ladies and gentlemen, it's been a great pleasure to present trusts and the valuation of trusts, and I'd like to just conclude with a saying: winners are not people who never fail, but people who never quit. Thank you very much. Have a lovely day, and God bless.